Thank you so much for stopping by my channel, 521 Investment. And I want to continue to talk about wealth building, how my net worth increased. And I want to talk a lot today about diversification and what I learned about diversification over the years. Now, this is worth repeating. When I began to understand financial language, my net worth also began to change. When I first started trading and investing, because I do both, I trade and invest, I had to open up a brokerage account and I had to learn the language of that brokerage account. Now, a brokerage account allowed me to buy and sell different types of investment, but I had to make a deposit in that account. If I did not make a deposit in the account, I didn't have any exposure to what I was trying to invest in. So the brokerage account allows you by deposit to have exposure to different asset classes, or it could be cryptocurrency or whatever. But the point I'm making here, you have to have some type of brokerage account. Now, a brokerage account mainly have two options. They have the cash account, which you can buy securities in this account with cash, but you're paying for those securities in full with cash. And I normally use my cash account. Also, they have a margin account. This allows you to borrow money in the brokerage account from the brokerage. The key thing here is you are borrowing money from the brokerage to buy securities, but there are more risks associated with a margin account. You're leveraging money, but there are risks associated with this type of account. Now, people use margin accounts all the time, and I'm not against a margin account, but I mostly use the cash account, and I may be using a brokerage account, a margin account in the future. Now, if you ever heard of the word short selling, a short sale, this is normally done by using a margin account. Now, my long-term investment in diversification is ETFs. My long-term investment in diversification is in ETFs, or electronic traded funds. And normally, before I make any type of investment, I try to gain some information by reading the prospectus, which will show the investment objective of the fund, the risks that the fund will take, charges and expenses. And also, you're probably going to read this in bold. It'll have this quote: past performance is no guarantee of future results. An investment return and principal value will fluctuate, so that an investor's shares, when sold or redeemed, may be worth more or less than the original cost. Current performance may be lower or higher than the performance quoted. The key word here is principal value will fluctuate. And normally that fluctuate with the market, because the market goes up and the market goes down and the market goes sideways. And there's nothing wrong with that, because that's the way the market should go. You may say, no, I always want the market to go up. No, you don't. You want the market to go up and you want the market to go down. The market also goes sideways. You don't want the market to always go up. You want the market to go down too. Because remember, you're investing for the long term. You're investing for long term. So you want the market to go up and down or fluctuate. That's the normal cycle of the market. Up, down, fluctuate. Up, down, fluctuate. Up, down, fluctuate. Now, I currently have 3 brokerage accounts. 3. I'm going to go over one today. And this is my main account that I use for my long-term strategy, or you may have heard the word buy and hold. And my buy and hold strategy is mostly ETFs. Now, you may be invested in mutual funds, index funds, and that's okay. But I use this account mostly for ETFs, or electronic traded funds. And this fund gives me the exposure what I'm looking for. Now, this is the name of my main account. It's Interactive Brokerage, or IBKR. Just Google that. Interactive Brokerage. And this is my account long term. And my long term objective may be different from yours. Is 3 to 5 years, or when it doubles. Now, that's my investment strategy, because you got to have a strategy. It's 3 to 5 year, or when it doubles. That's my investment strategy. And yours may be completely different. You may be investing for 5 year, 10 year, 20 year, but my strategy is 3 to 5 year, or when my investment double, I'm going to sell that fund because it has met my objective. When it meets my objective, I'm going to sell it. So here's a word of wisdom. If the fund or what you invested in has met your objective, what are you going to do? Me, I'm going to sell it because it has met my objective. I said it again. When what you invested in has met your objective, what are you going to do? I'm going to sell because it met my objective. Now, you can do whatever you want to do, but that's what I'm going to do. Now, in this fund, I have two core holdings. One is for large cap investment, and the other is for small cap investment. Now, there are many funds out there, and I'm not telling you to invest in what I'm invested in, but you should be invested in something large cap, small cap, mid cap, or whatever. But I'm going to share my two core holdings. Now, here's the symbol, SPLG. You can Google that, SPLG, and you can read about it, because that's the way I started to invest in this fund. I Googled it, and I started to read the perspective, and it met my objective of what I was looking for. And listen, I'm going to go over a little bit about this fund, SPLG. Now, this is a low-cost ETF that seeks to offer precise, comprehensive exposure to the large cap market segment. This index represents 80% of the U.S. market. This portfolio is designed to provide broad, diversified exposure to core asset classes. The expense ratio is 0.02%, or $20 for every $1,000 invested. So it's going to cost me $20 for every $1,000 invested. Now, listen to this. This fund's top holdings are, here are some of the top holdings in the fund. Not all of them. Here's other top holdings. Microsoft. No, who haven't heard about Microsoft? Apple. Nvidia. Probably heard about Nvidia a lot in the last year. Amazon. Who haven't had Amazon deliveries? Meta. Alphabet Class A. Berkshire Hathaway, or Warren Buffett funds. Alphabet Class C. Eli Lilly, and Broadcom. Now, the fund breaks down by sector, or diversification. Diversification and asset allocation strategy do not ensure a profit. Just because I diversify, it does not guarantee me a profit, but being diversified protects me against losses in a declining market. Or let's say we're in a bear market. It helps me in the bear market when everything's declining. I'm going to go over the 11 fund sectors because there are 11 fund sectors. And this is how SPLG is diversified. Now, this information constantly change. But number one, information technology. This is the sector. 29, almost 30% SPLG is invested in information technology. Now, I want to put this out right here. This is how you're diversified in sectors. Information technology is a sector. Now, think about this. Not having all of your eggs in one basket. Is it wise to have all of your eggs, all of your money just in information technology? It could be a good strategy and it could be a bad strategy. It's up to you. But the point I'm making is I think it's wiser to be diversified. Now, some people don't believe in diversification. They'll put all their eggs in one basket and invest just in information technology. And if that's what you choose to do, do it. And if it's working for you, work the process. But I think it's better to be diversified by sectors. Now, here's this fun again. Information technology, almost 30%. Financials, almost 14%. Healthcare, almost 13%. Consumer discretionary, almost 11%. Communication services, almost 10%. Industrial, almost 9%. Consumer staples, almost 6%. Energy, almost 5%. Materials, almost 3%. Real estate, almost 2.5%. And utilities, almost 2.5%, or close to 100% diversified. But they're diversified through sectors. So all of the assets are not just in information technology, and you probably heard a lot lately about the Magnificent Seven. You probably heard a lot about, if you listen to CNBC, Fox, Bloomberg, I know you heard the Magnificent Seven. And that's mostly information technology, but this fund is diversified. A large percent, almost 30% of the fund is in information technology, but not 100%. Almost 30%, but not 100%, because they believe in diversification. And also in this fund, you can read the historical performance of the fund over the last 5 years, and that's in the perspective. You can just read that on your own if you're interested in the SPLG. Now, this is my large cap investment. Now, my small cap investment is SCHA, or the Charles Schwab U.S. Small Cap ETF. Now, the expense ratio for this fund is 0.040%. Other words, for every $1,000 invested, it's going to cost me $40, which is fairly low expense ratio. Now, the reason that I invest in the small cap U.S. fund is I'm looking for eventually the Federal Reserve, Jerome Powell, they're going to start cutting the interest rate. Now, at the beginning of the year, or late 2023, they were talking about how many rate cuts we were going to get within 2024. First it was 6, then it went down to 4, 3, 2. The last I heard is 2, and I think I heard the Fed say we may not get any rate cuts this year because inflation is still high. but that's okay. Because remember, I have a long-term investment strategy, and I'm looking for when the Fed do start to cut rates, the small caps will outperform the large cap because uh, the small cap companies will have access to more capital at a lower rate. So they're going to borrow money at a lower rate. And when they begin to borrow money at a lower rate and invest, I'm looking for the shares of SCLG, SCHA ETF to outpace SPLG. I'm looking for this small cap ETF to outperform SPLG. Now, I can't guarantee that's going to happen, but that's my strategy. I'm thinking SCHA will outperform my large cap company because they'll have more access to money or capital at a lower rate. Now, that's my strategy. Now, I'm going to go over a couple of their large holdings in SCHA, the small cap ETF. Some of these companies you probably never heard of. And I'm going to be honest, a lot of them I never heard of it. MSTR, MicroStrategy Incorporated. NTNX, Nunatex, Nutanix, how that's pronounced, whatever. FIX, Comfort System USA. Now, let me go back quickly. MSTR, now I heard of MSTR, 0.70% is invested in MSTR. And I think the last I saw on a business channel that MSTR share was close to $1,200 a share. So I heard of this. Then ELF, Beauty. WING, Wingstop. I'm probably sure you heard of Wingstop. THC, Tenet Healthcare Corporation. NTRA, Natara, NATERA, however that's pronounced. TXRH, Texas Roadhouse. You probably heard of Texas Roadhouse. CNM, Core and Main Incorporated. And BWXT, Technology. Now, a lot of those companies, I have never heard of it. Only maybe 2 or 3 I've heard of them. The Texas Roadhouse, Wingstop, and the MicroStrategy. Now, I heard of those. But the point I'm making here, this is a long-term, small cap, diversified wealth building strategy. That's my strategy because I'm thinking that this ETF is going to outperform SPLG over the next 3 to 5 years, or as I always say, when it doubles. If it doubles SCHLA in the next 3 to 5 years, I'm going to sell it because it has met my objective. So I'm not going to hold it 10 years if it has already met my objective. Whenever it meet my objective, then I'm going to sell it. But the key word here is diversification, because this fund is also diversified, but it's diversified over the small cap companies, not like the big dogs in SPLG. Now, I think it's wise, and this is what I began to do. I use recurring investment option in IBKR, or you might call it automatic investment, which allows me to choose a date and select a schedule on which to invest, whether it's weekly, monthly, or quarterly. This helps me to be more consistent in my investment long term, because when you're investing long term, the key word is being consistent. So the recurring investment or automatic investment in IBKR, and I'm quite sure if you have a brokerage account, you have that investment option. I can choose the date, the time, and the amount. And when you're first starting out, the amount is not what you should focus on. It's being consistent. I say that again. It's not the amount you should focus on. It's being consistent because it could be as less as $5, $10, because people buy fractional shares, $100, $200, $500. So if you can't start investing $100, $200, start $5 or $10, but be consistent or buy fractional shares until you can buy a whole share. But be consistent. Here's the spiritual principle. You know me, I like putting spiritual principle. And it's this: do not despise the small beginning. Do not despise the small beginning. In financial language, is $5, $10. Don't say that's nothing. It's a lot, but you're starting small. You're being consistent. That's the key. Be consistent. $5, $10. And then when you can double that amount, double it to $20 or $30, $40 or $50 or $100 or $200 or $500 or $1,000, whether it's weekly, monthly, or quarterly, or whatever. But the key to long-term wealth is being consistent and being diversified, and don't have fear of the market, because market goes up, markets go down, and they go sideways. That's part of the cycle of the market. Now, don't try to time the market. Say, what? What are you talking about? Don't try to time the market. Other words, timing the market is buying securities when the price is low and selling when the price is high. You might say, that's what I want to do. That's what you should do. But that strategy is for when you're trading stocks. That strategy is when you're trading stocks, where you want volatility. That's when you want to buy low and sell high, because you're looking for volatility. You're looking for volatility. That's trading. And remember, at the beginning of this video, I say I trade and I invest. So I buy low and I sell high, but I'm trading then, or I'm swing trading. I'm trying to buy something low and I'm selling it high, and I'm looking for a profit. I'm looking for some volatile, in and out, in and out, in and out, in and out. That strategy is my timing the market. That's what I'm doing. I'm buying low and selling high. I'm trying to time it, the right time to get in and get out. That's what I'm doing, but I'm trading then. I'm not using a buy and hold strategy. I'm not worried about diversification then. I don't want to be diversified. I'm trying to buy low and sell high. That's what I'm doing, but I'm trading then. And always remember, make adjustments to your portfolio when needed. Always look at your portfolio. Always look at your portfolio. Don't just invest long term and never look at your portfolio. And you shouldn't look at it every day unless you're trading. And you have to get in and look at it then. But if you're investing long term, don't just look at your portfolio once a year, because you may need to make some adjustments. because long-term investments also require you make adjustments in your portfolio when needed. Long-term investment diversification also means you make adjustments in your portfolio when needed. Now, on my next video, I will share my other two uh, portfolio and also my brokerage that I use. It is Charles Schwab account in my Moo online and mobile app trading platform. Again, I have three. I went over IBKR, Interactive Brokerage, and I share my Charles Schwab account. A lot of you probably heard of Charles Schwab account, and Moo online and mobile app trading platform. I have three, and they all have purpose. And if you look at my wealth building pyramid behind me, they all serve that wealth building pyramid strategy. I don't just have those a brokerage account just to have those accounts. There's a strategy to my Charles Schwab account, and there's a strategy to my Moo online and mobile app trading platform. And it's in that pyramid that you see behind me. It's all in that image. So whatever image that you have for your future, whatever image is in your mind, you should have something, some type of vehicle, some type of investment that's going to take you there. So what you see behind me is my vehicle to take me where I'm trying to get in the next 3, 5, 10 years. It's all in my image behind me. So you should have an image. Remember, on my last video, financial language, and I made reference to the book of Genesis. It says the people had one language. They spoke one language. They had an image of what they were trying to do. And God said nothing will be restrained from these people. And he came down, saw what they were building, and he confused them. So they couldn't understand each other, and they stopped building. They stopped building. So you have to have some type of image of where you're trying to go, the financial language and vehicle to take you there, a strategy, diversification, which is long term, not having all your eggs in one basket. And I will share with you at the apex of my pyramid, that is where I take risks. I take a lot of risks at the apex of my pyramid. At the apex of my image, I'm going to take more risks. But I'm not taking 30, 40, 50% risks at the apex of my pyramid. No, I'm going to take risks, but it may be only 5% of what my total portfolio investment. It may be only 5%, 3%. There's a percentage, but it won't be 30 or 40%. I'm not going to take 30, 40% of risk at the apex. No, I don't think that's a wise investment, but I'll take risks. And that could be whether in cryptocurrency, my option trading, and that's, I share most of my Charles Schwab account and Moo online investment app will do. It will be for cryptocurrencies, and it will be for options trading. So where you don't have no purpose of those accounts, you can abuse them. You have to have a purpose for your brokerage account. In other words, you abuse them or misuse them. There's got to be a purpose. Never open up a brokerage account. You don't have no purpose for them, just to have one. No, it's a purpose for those accounts. Now, please subscribe and share this video. Until we meet again, peace.